Hello and good morning, listeners. Welcome back to Almus Market Mornings with Jayaram Krishnamurthy, your daily window into the ever evolving financial markets. There's a renewed buzz around a potential ceasefire, and markets are beginning to take notice of the same. USDINR being one of them, with a softer trading levels in the last few days. Adding to this, the central bank has reportedly nudged the state run oil companies to ease their spot dollar demand and instead rely on the special credit lines for their FX requirements. On the global front, Trump has struck an optimistic note, suggesting that the war in Iran is going swimmingly and should be ending pretty soon. So, JK, how should we interpret these developments? What signals are the markets really picking up here? And beyond the headlines, what else should all of us be watching out for in the current environment?
Morning, Shikhar. Um, so, yeah, I think RBI is in a kind of crisis management situation, and the measures that they have been taking are quite strong and completely aimed at seeing that the rupee does not weaken more. It's already weakened a lot during the last 1 year, and uh, it's undervalued against a host of trading partners' currencies. And the uh, capital flows are still missing. We are in a position where we have to manage in a very delicate way, because we might be ending in a balance of payment deficit in the year if the capital flows continue to elude us, and the trade deficit is definitely going to rise in the coming months, notwithstanding a fall in the March deficit, which was entirely due to lower imports and exports as Middle East war broke out. We had these directives earlier in the month when they curbed the open positions for banks on the local books, and that led to a lot of unwinding of long positions by the banks and corrected WP from 95 to 90 to 50. And since then, we have seen again a tendency in the USDINR to go up. And of course, 93, 40, 50 had been resisted due to central bank selling. And it was clear that the measure announced earlier was temporary impact. So central bank had to resort to more measures, and that is where the directive issued has come in to the market. And state-run oil companies have been directed. I think it won't be something like they have to, but they have been given a direction to curb the spot dollar purchases and tap the special credit line of foreign exchange. Which this is a measure which they had resorted to even in Ukraine war. In fact, we have seen in past also they have resorted to such measures when the rupee came under intense pressures. In fact, they have also been directed to route their purchases through State Bank of India alone, because that could lead to more efficient management of the flows. Because State Bank runs a huge flows on both sides, and the net impact on the market could be far limited if when the oil companies enter to buy the market. So I think this is good, definitely going to have some impact on the spot rate, because one, there will not be too many banks looking to buy dollars for the oil companies. That's one aspect. And the total demand itself, like if you take our overall import bill for oil, it's about 250 billion. And if that demand is not coming into the market, straight away you can remove about 1 billion of demand from the market. And that's a big relief for easing the demand supply mismatch. And that's where the RBI's directive could work. Once again, this is going to be a short-term measure, and it's not going to, set right the deficit, constant deficit that we are running, and in the face of missing capital controls as well. Sorry, missing capital flows as well. In the earlier cycles, which RBI announced that they opened a window for oil companies to access dollars from RBI directly. At least it is not that much, but they will get dollars at the market rate, but it will be confined to a single bank where they will be routing the transactions, as well as the transactions itself will be limited because instead of spot dollar, they will be accessing the credit lines that is available to them. So my view is that it's going to have a short-term impact. Dollar rupee can once again move towards 90 to 50 as the lack of demand probably pushes it down. So I think the RBI's measures is now looking to curb the excess demand from the market, and we already know that the banks are now unable to access the offshore market, which actually reduces the volatility in the domestic market for USDINR. And these measures, together with what is announced yesterday, is going to reduce the demand from the market substantially and help the rupee to be stable, to some lower levels. I would probably think that 90 to 50 is going to be retested once again. However, we should not forget that we still run a large deficit in the trade account, and those general the import demand will be there on dips. It's not as though the rupee is going to crash. It's not likely because we also know that exporters are also not coming forward to sell in a big way. I think what we need is long-term structural change where we see the deficits consistently lower, and perhaps the capital flows easing measures could be on the anvil. Perhaps these measures by RBI are also buying time for the policymakers to arrive at some more stronger measures which could improve the capital flows as well as reduce our import dependency. So that is what we should look forward to. So in the meantime, we could see some stable market. On the global side, we had the markets rally on quite a bit of optimism after the initial ceasefire talks had failed, and second, Iran and US are expected to meet in Pakistan for further talks. There have been several statements on the war ending soon, etc., about reopening of Hormuz Strait, but none of them have been followed up with any concrete agreement or even action. So that is where the markets have become a bit cautious now. In fact, some analysts are indicating that the comprehensive agreement between the two countries could take as long as 6 months. Now, that means the oil price, etc., are not going to correct themselves or come back in a hurry. Yesterday, in fact, we saw oil price once again rise by about 4%. Now, what this will do is that the central banks, assuming that the rise in inflation due to oil price is going to be transitory, will not happen. It won't be transitory in the sense that it will immediately reverse. It will be sustained for a long time, and the central banks will be forced to deal with higher inflation. And there's already a sense that the global growth will come off, as per IMF report, to 3.1% this year, and they have downgraded growth in most of the countries. So it has a lot of implications for the inflation and the monetary policy. So we should be watching out for how the central bank's approach as a comprehensive agreement takes more and more time. I think we have rallied quite a bit based on optimism, and reality check for the market is very much on the cards. And in fact, if you look at the growth picture, yesterday we had the Chinese growth number come to 5% from 4.8%. UK growth from 0.1 to 0.5%. These were the jumps based on the activity levels rising just before the war. So these numbers have been not reacted to because market views that this is not going to be sustained because as the war has continued and the prices have remained high, growth activity has been affected. The growth numbers are going to be lower. In fact, we had seen yesterday that the government of the German government actually has downgraded their growth prospects for 2026 to 0.5% from the previous 1%. In fact, it is lower than what the IMF had projected for them at 0.8%. So I think S&P 500 and Nasdaq already hit new highs. Despite the fact that war has not seen any signs of ending soon. So I think a lot of optimism has been priced in, and we are in for some correction there. Dollar has also been falling of late. That has actually stopped yesterday. Once again, we are seeing dollar index trying to rise. Of course, dollar could be a different story because there is a certain amount of negativism about the dollar's overall holdings by the central banks. However, we should see markets correct their recent rises. That applies even to India as well, where we have seen more than 7% rise from the bottom. I think with near to the news, markets will be trading cautiously from here on. Thank you.
Okay, JK. And yes, folks, the capital flows remain elusive on the domestic front as JK began in the today's podcast, and thereby all of this has kept the pressure for the currency on the move on the higher side. But at the same time, so has the central bank been acting in the crisis management mode to keep the volatility and the action on the limited side. Such measures does have some short-term impact, which we see not just from the urge to buy from the special credit lines and at the same time limiting the way the positions are being managed in the onshore and the offshore market. So we can see some short-term implications on the currency's performance, but at the same time, on the global front, we've seen some bit of optimism by the way the discussions and the updates are being coming on the war front. And we can also see it in the manner the equity markets have been rallying. Although a reality check is required since S&P was seen having new highs despite there is no end to war. So some sort of reality check is required in the form where uh, the markets have also not really reacted to the growth numbers. Which were published by UK or China on the higher side, yet so we can see some bit of corrections or some bit of reality check coming in. But that's it for today, folks. We shall come back again tomorrow with, not tomorrow, rather on Monday with another round of updates. Thank you so much. Signing off this podcast with the regular saying of TGIF. Thank God it's Friday. Thank you so much.